Today's video is on managing risk. The portfolio has had a huge move recently, as you know, along with the market. So if you stick around to the end of the video, I'll discuss with you some of those strategies on how to manage risk when the market is at the highs. So we earn over 100,000 per year in dividends at this channel, and we're also outperforming the market. Today, we're outperforming on a daily basis. We're up 0.76%, whereas the Dow's up 0.41, the Nasdaq's up 0.6, and the S&P is up 0.63. So we're beating all the indexes on a daily basis. And on a year-to-date basis, you can see that we're also up 33% for the year, almost 34%. The Dow's up 2, the S&P is up 13, and the Nasdaq's up 28%. So we're beating all the indexes, both on a daily basis and on a year-to-date basis. I have three main reasons why I beat the indexes. One, I tie all my investments to the indexes. Two, I have Cornerstone, which Cornerstone is a huge vehicle for me. It's obviously, you can see we're up another, here we're up another 2,500 for the day in Cornerstone. So this is, it's up 0.78 and 0.69% Cornerstone, and it tracks the indexes. So that's why I'm getting this performance. But not only does Cornerstone track the indexes, all my subscribers know this. And so I apologize to be redundant, but for all new people who are here at my channel, Cornerstone takes its dividend each month. See this price of $8? It takes its dividend and reinvests the 21% dividend that it pays down at the NAV of 6. So $6 here for a 29% gain. We have $6.79 here for a 23% gain. We have $6.54 for a 28% gain. So this goes on and on each month. I reinvest the 21% dividend back at the NAV, not this market price. That's the advantage of Cornerstone. And that gives you not only capital gains from those drip shares, but it compounds your 21% dividend into a bigger dividend because it's compounding that 21% each month. And then you get days gains as well, 0.78, 0.69. So you get all three advantages with Cornerstone: drip shares, profits, compounded dividend of 21%, and you get days gains potential here of about $2,400. Once again, this is almost $3,000 right here. 1,000, 2,000. So this is over $3,000 in Cornerstone from one day. You just have to play Cornerstone properly. If you look at a chart of Cornerstone, again, sorry to all my subscribers who know this, but look at the chart of Cornerstone. It goes into the ground over time. And so you have to buy this fund and play it properly before its rights offering, which I help you with. If you need help playing Cornerstone, email me for my e-guide at akintodd48@gmail.com. I also have a Discord server where I alert you of the rights offering announcement. So if you already bought my e-guides on Cornerstone, then you're welcome to this Discord server. So going down the line, Cornerstone, that's where we're getting our performance. Also, let me briefly show you guys that this margin debt that I use, this $273,000 in margin debt, is where I'm getting my performance as well. So I get it from Cornerstone. I get it from tying my investments to the indexes, but I also use margin. For every $1 you put in your account, you get $4 of purchasing power. So I'm simply using a fraction of this buying power to get more income and performance out of my names. Even TQQ and FNGU, which today I trimmed some. So I had 5,000 in TQQ and FNGU, and they don't pay dividends. So when I was up $200 in each of these, I was up 5,200 and 5,200. I just trimmed back my core position to be back to 5,000. That's one way I manage risk in TQQ and FNGU, because I'm using margin. And so I only like to buy things to get income, more income through my margin. That then pays down my margin debt. My margin debt, I'm charged 5% interest because I negotiated down twice. And the securities that I own, like a Cornerstone or Yield Max, these Tesla Yield Max, 60% dividend or 20% dividend for Cornerstone, they more than cover my margin interest. So that's why I don't mind holding on to margin. It gets me more dividends. And again, you can use some of it, like I just showed you, for TQQ and FNGU, which don't pay dividends, but they're giving me extra returns here, 1,000 and 1,000 between the two. And so I just keep trimming out accordingly. When my core position of 5,000 gets up to 5,500, I trim 500. Today it was up at 5,200, so I trimmed 2, and I trimmed 2 out of each, two out of TQQ and 2 out of FNGU. I'll go show you my alerts here on my alerts page. If you need help with playing margin, email me at akintodd48@gmail.com. That's how I live financially free, is through not only these dividends, but using some of this margin, which doesn't show up on a credit check. and it just acts as qualifying income to banks. When you get more dividends out of your margin, the banks see that as a pay stub, and that's how I was able to get my car that you saw recently, or the house that I live in. It's all from dividends, and I use a little bit of margin to get more dividends. You just can't use too much margin. You should only use about 10 to 30% of your account in margin. So you have to learn how to play the cornerstone rights offering properly, and you have to learn how to play margin properly if you want this extra performance. I can't go into the thread and watch all those comments because it hurts my eyes. So I prefer email, but that also hurts my eyes. So I just really prefer talking over the phone, which when you buy my e-guides, you get my phone number. So I know questions are coming. That's why I'm directing you to my e-guides already in my email at akintodd48@gmail.com. I hope you guys understand this. Here are my alerts. FNGU, we sold some FNGU. We bought a QQQ put there, as you can see. We closed some puts on Highbull and IEP, and we sold some TQQ there. So we trimmed. That's one strategy I use. So you see my alerts there, okay, guys, right? You see these alerts. So I've trimmed some things that I'm up in my core position. That's one way to manage risk. You take your $5,000 core position, and if it's up to 5,200, you trim it. You just sell out 200, and you're back to 5,000. You want to take profits of some sort when the market has a run, or you'll be kicking yourself that you didn't at least take some gains on the way up. So TQQ, I trimmed that, but I did not trim these other names because they provide valuable income. I'm not going to trim names that provide income and qualifying income to the banks. I don't want to lose my payment history to the banks. Plus, I want as much income as I can. So I'm never trimming from my income names. I'm only trimming from these 75% maintenance names and names that pay lower dividends. I trimmed my Schwab D, for example. We had 5,000 in it as a day trade recently. So I trimmed some of that just because it doesn't pay much of a dividend. I wanted to lower my margin and lower my risk. I still believe in Schwab D and every one of these plays, but you have to be prudent and manage risk as the market runs higher. So I trimmed out of things that were non-paying or low-paying dividends. I closed out these put options, which are a more advanced subject. If you need help with dealing with options, just email me. We could talk about that later. So I closed some puts for my options, which gave me about a $300 gain. I closed my Highbull put. That also raised a lot of equity because Highbull is 100% maintenance name. So that raised 3,000 of equity because Highbull is 100% maintenance. Again, if you need help with learning what maintenance is, that's part of my margin e-guide. It's in the e-guide there. So here we go. I'm moving down the line here. I just shared with you that one strategy I use to manage risk: trim names that don't pay much of a dividend back to their core position. I also close out puts to raise equity. That's the second thing that I did. And I like selling these puts and owning them because I don't have to own them outright. They don't pay dividends, so I own them through the puts instead, which just lower my margin interest further. I sell the puts, I lower my margin interest, and I still control the security without taking the risk. Usually when you sell puts, you also lower your cost basis in the process. So again, it's more of an advanced strategy. If you're interested, just email me for that. So I closed my puts. I trimmed shares of non-paying, of low-paying dividend names. And then lastly, I added to my put insurance. So I added a Q put right here. I added one contract at 300. I'm already rolling my puts into my put options into the next month because this month they're expiring worthless. Buying put option insurance is a losing endeavor. I warn you. I just have a larger account size and margin debt, so I have to always protect myself from a black swan event. Will only $50 on a put option do any good? Not on a typical down day, but on a black swan event. In a black swan event, that can turn to a lot of money. So you want to just keep a small amount of put insurance on, kind of like house insurance. And yes, you have to take that loss each month, but it's worth it in case a disaster strikes. So that's what I'm doing. And there it is there. I bought one Q put there. So that's what we did today to manage risk in the portfolio, guys. We trimmed names that were above our core position that didn't pay a large dividend. We closed out some puts that raised a bunch of equity back and just gave us a profit to do it. Again, you see that we're up about 400 in profits just from closing those puts. And then we bought short insurance on the S&P and NASDAQ. It's just black swan insurance. It's probably going to lose, but I'm doing it anyway because I want to protect myself and live financially free and be able to sleep at night. Can't just live off dividends. You have to have performance. So you don't just go into the ground and break even with your dividends. You also have to be able to sleep at night with your dividends and using margins. So I keep option insurance on at all time. at all times. Plus, I keep my margin debt low enough to where I can still sleep at night. As long as this equity number is high, then I'm sleeping well at night. I know that this has to go to zero before I reach a margin call. So, and if at any point that happens and the market gets really dicey, I can sell from these higher maintenance names like FNGU and TQQ. FNGU here, TQQ here. I could sell. That's 10K right there that I could dump and not lose any income because they don't pay dividends. Plus, they have high maintenance. So I know exactly where I'm selling from to raise my equity, to lower my margin, and to not lose income in the process. So anyways, that'll do it for the video, guys. I hope you enjoyed it. We're managing risk. It's not fun to talk about selling things when the market's going up, but you have to be prudent in all times. So I hope you enjoyed it. Leave comments in the section below if you have any more questions, and I'll talk to you soon. Thanks.